9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with Annabelle Jewelers.
We're counting down to the open of markets in Greater China, and our top stories this morning will U.S. House lawmakers set to vote on stopgap funding to end the record-breaking government shutdown. President Trump expected to sign that measure into law once it passes.
But trading in Asia remains cautious after the White House warns that key inflation and jobs data for October may not be released, leaving the Fed, quote, flying blind.
Also ahead, oil prices dropping as OPEC flags a surplus in global markets that's due to its own production hikes, coupled with the growing output from the U.S.
And China's biggest company, Tencent, set to report earnings with its AI investments and gaming ventures under scrutiny. JD.com and SMIC also releasing their results today.
Well, a quick look at the market action, and certainly there's a lot of eyes that are on the U.S. House this morning because we may be moments away now from a vote happening on a spending package to end the government shutdown. This has been a record 43-day shutdown period. You've had 650,000 government employees furloughed, but already we've got these indications. They're being told, you get back into the office for Thursday. But yes, that sort of sets the stage for us as we come into the session today because President Trump, he is expected to send or sign that spending bill once it passes. He's already indicated he will do. We just had an alert crossing the terminal that he does plan to sign that bill to end the shutdown at 9:45 Eastern time. So that's 10:45 for us here in Hong Kong this morning. But in terms of what we're seeing in market action today, it's very much subdued trading, you can say, and that was the tone that we had on Wall Street overnight. What's happened during this shutdown period is you also got real gaps that are transpiring now in the government data. So yes, we could get the September jobs figures. We may never get those figures for October. So it certainly complicates the picture for the Fed, who's trying to assess not just the inflation outlook, but also the jobs market. Are we seeing those real trends of weakening in the labour market taking place? So that, again, was sort of the major overarching theme for equities in this session. In Asia today, there's a couple of different themes we're tracking in addition to that. Firstly, in Japan this morning, keeping a very close watch on what's happening with the Japanese yen. We just breached that 155 level overnight. We are getting more signs of intervention, a few comments coming across from the Japanese finance minister. In Korea as well, we do have the Kospi just coming online this morning to the downside here. But just to note, it is a 1 hour delay because there is the college entrance exam taking place. I can see that red head there as well. The U.S. House now voting on this bill to end the government shutdown.
Yeah, it looks like that's happening right now. Let's get to your live pictures out, of course, in the U.S. and D.C. And certainly, as we mentioned, President Trump plans to sign that bill at 9:45 Eastern time in the evening. So certainly that's one to watch. There you go. You are seeing right now in terms of the votes being tallied, nay in terms of Democrats is about 85 right now. Republicans are about 80 in terms of yay right now. So we'll get to the latest once we get those votes. Certainly this does lead to, rebooting the government and the process that could be underway. That does take days, if not even weeks. It's a great story that we talked about here when it comes to how quickly they can actually come to putting people back at work when it comes to the airline disruptions and the like. Certainly that's going to take a while. And on the back of course, the data that releases and the White House saying, look, yeah, we might not actually get some of the key data that the Fed has been watching and waiting for as well. For more, of course, on this U.S. House vote, let's get to our senior editor, Derek Wallbank. He's watching all the developments there. Derek, give us the latest here. How, is this going to be a pretty much sure bet that this is going to go through?
Well, a test vote just an hour or so ago went through with little problem. Donald Trump is expected to sign this measure at 9:45 p.m. U.S. Eastern Time. That would end the longest government shutdown in U.S. history. As you quite rightly mentioned, these things don't just necessarily snap back. It could take a week or so for all flights to be coming back to normal, for people to get all of their food aid, people who are on food stamps and things like that. This could take a while. We're still waiting for details, for example, of when some of these economic indicators that we have not seen during the shutdown when they may come, if they may come, because some of them just may not be in a condition to release, the White House previously said. So not expecting any drama during this vote. You never know until it's done, but not expecting any drama in this vote. As I say, a test vote on this, a procedural vote, did already go through within the last hour or so by a narrow margin, but it went through. And so all signs are that this is coming to an end imminently.
Let's talk about some divisions and areas that maybe the Democrats can exploit. We've just been hearing here that Speaker Johnson is saying he will bring the Epstein files vote to a House floor, or to the House floor next week. How is that likely to complicate, I guess, the picture and the assessment of what the Trump administration is doing?
Well, it's certainly something that the Trump administration had tried to not get going. That is going to be a very difficult vote for a lot of Republicans to take. There are some thoughts that there could be a fair number of defections among Republicans actually going for and supporting that vote. But look, when Adelita Grijalva was sworn in after quite a long time, when the House came back, she was that clinching vote 218. Mike Johnson making it very clear in a conversation with our Eric Wasson that he was going to put this up next week. That's before the Thanksgiving holiday. He said it's going to just sort of be a straight vote on the measure, not some sort of gimmicked kind of situation, and give people a chance to vote. The idea is there, as I read it, sort of rip the Band-Aid off and sort of deal with that, and then go on the Thanksgiving holiday and go from there. But look, the revelations in this have been something that have been kind of a drip, 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 drip for this White House. It's been a very sensitive subject for this White House, and certainly this is going to be a bit of a difficult vote.
Derek. Thank you, Derek Wallbank there, our senior editor that's watching all that's happening there in D.C. And certainly we'll circle back to that once we do get the official votes there. Let's talk about what this means for markets and bring in Mark Richards, head of dynamic multi-asset at BNP Paribas Asset Management. Mark, it's good to have you here in our studios. I mean, you know, markets are bracing for the reopening of the U.S. government, but we're missing some key data, and we might not even get some key data. How should really investors look at this right now? Because the private data has not been very comforting.
Sure. It will certainly be a relief to have those numbers back in our field of vision. I think compared to maybe several years ago when we didn't have that kind of breadth of alternative data, it's not been as worrying in terms of trying to dissect what the outlook is for the labour market in the US. Using some of your own data in terms of transcript searches of company reporting, we've been able to kind of glean a little bit more colour. So use of that alternative data, but the big picture is for us is the labour market is weakening. So the question is always, are there non-linearities between a slowdown and then that kind of sudden drop? We're not really seeing that. There's been pockets of worrying data, like the Challenger job cuts that we had last week. But then we look across the breadth of company reporting, we're not seeing that non-linearity. But it is clearly a relief to have some of those numbers back in our field of vision.
So then how are you assessing the outlook then? If you're saying, is it just going to be sort of general weakening trend? Is that what you're anticipating then?
Yes, definitely. I think we've had now for probably 2 or 3 years, excluding kind of healthcare, government employment, really no job growth. You know, we look at the large cap US companies, no real job growth. We had, I think, Walmart report a couple of weeks ago saying, even though we see reasonable revenue growth in the next 2 or 3 years, we're probably not going to hire anyone. And I think that's just a structural issue we have to deal with now with, you know, AI coming through. We see more signs of difficulty recruiting grads. You know, unemployment rate for grads is quite high relative to the rest of the market. So there's that kind of structural softening of the labour market, which then we think about the Fed's reaction function. We do think while there's a dual mandate and a balance of risks around inflation and full employment, they will always lean on the latter of those two. So I think it is still kind of an easing bias into next year.
Does that give at least an anchor to risk assets as we count down to 2026 now?
Yeah, I think so from one dimension. We always think about a combination of fundamentals, that policy lever, and where sentiment and risk appetite is. And I think really a feature of the past several years has been less of a clear line of sight from a pure macro to risk assets. We know about index concentration. It's probably just as important to think about what those individual companies are doing and how they're performing.
You mentioned the increasing AI, but I think it's also that automation story that we also have to think about as well. How are you thinking about the pace of technological change and what it means for you as well?
Well, it's rapid, isn't it? I mean, for us,
it seems rapid. I just wonder sometimes at sort of the factory floor level, is it so rapid? It's still a big adjustment to make.
Yeah, I think for companies choosing whether to hire or fire is probably a softening on the hiring, and that's where we see, the hiring intentions just aren't really coming through. They're happy to have a more productive workforce and just hold hiring quite constant. In terms of the rapidity, I guess it's two real big structural things that we have going on. We have an AI, what I'm calling an arms race, and then we have kind of the geopolitical tension. And clearly there's some overlap on those two topics, but it's really that kind of accelerating pace of AI adoption that we have to look for.
So in terms of multi-assets, I mean, what are we likely to see outperform for this year? I mean, it seems like everything has been doing quite well. Stocks, bonds, metals, alike.
Yeah, I mean, there's always a temptation at this time of year to think, okay, we have a changing calendar year, therefore we should change our whole strategy. Yeah. The main positions for us is still around what is the kind of the second concentric circle around the AI theme, and thinking about the supply chains, thinking about, Korea has been a good position for us for the last 6 months. We're sticking with AI-related thematics. That also speaks to kind of things like nuclear, things like utilities sector, both US and Europe. Yeah. But it's really watching for that sentiment angle. When does the euphoria start to kick in? And then kind of moderate positions, rather than saying, valuations have become too full, therefore we take profits. I think just looking at sentiment and positioning.
Yeah, and thinking about sentiment positioning and also sort of the general run-up or hot topics or themes for this year, it's been gold, of course, as well. Are you sticking with that view for next year?
Yeah, I mean, we've had it in portfolios for a good kind of 2-3 years as being really a play on concerns about fiscal deficits and government debt as being a role in multi-asset portfolios. I think concerns about the role of government bonds has probably reached kind of quite euphoric areas. Okay. Similarly on gold, we've seen the narrative around gold become quite euphoric as well. So maybe switching a little bit out of gold back to traditional safe haven fixed income. And we've been looking at inflation protected securities in the US to just kind of hedge against maybe inflation being structurally higher, but have some kind of play on that angle around Fed being a bit more focused on that labor market part of their mandate.
The dollar seems to be coming back in some ways. This whole carry trade, if against the yen, against the Swiss franc, I mean, you're seeing it across even the yuan in the last week as well. I mean, how sustainable do you think the strength that we're seeing in the greenback is going to be now?
Not hugely sustainable. I think if we go back 3 or 4 months, what was the most consensus position cross asset? It was to be bearish the dollar. Yeah. And then you've just seen kind of a stabilization, making slightly higher highs, a bit of a change in trend. But I think those fundamental concerns that people have around twin deficits, institutional credibility, still kick back. I think we've got maybe a change in the dynamic in terms of what we saw in Q1, Q2, where people questioned US exceptionalism. I still think there's a place for US assets in people's portfolios. It's not that flood of taking assets away that people were concerned about. So kind of range bound, we're really looking for pockets of FX trade. So we like things like the Brazilian real in terms of commodity exposure. I saw we had pretty good labour market data on Australia this morning. Still like the Australian dollar. So yeah, those are kind of two positions for us.
Maybe some room for diversification, which we're going to talk to you about in the next block. So stay with us, Mark. That's Mark Richards, the head of dynamic multi-asset at BNP Paribas Asset Management. And coming up, we're also going to be taking a look at the oil markets, speaking with VANDA Insights about their outlook for crude. That's as prices post their biggest drop since June on signs of a surplus in the global market.
Of course, I'm waiting for the results of that ongoing vote to send a stopgap funding measure to the White House for President Trump's signature. We're watching that as a countdown, of course, to the open of markets in Greater China. You're watching The China Show. All All right, we're taking a look at live pictures there right now. Of course, we should be just moments away from this House vote to be tallied here right now. Right now, we're seeing around 203 yeas from the Republicans, 201 nays from the Democratic side of things as well. So the time is up, as you can see there. Certainly, we'll see what the market reaction is so far. U.S. futures have also erased those early losses. You're seeing NASDAQ 100 contracts are also perking up here on the anticipation that the government is going to reopen maybe soon, right? And maybe we'll see when it comes to data being released. This whole kind of information vacuum that we've been dealing with for weeks now finally coming to an end, possibly.
Yeah, we were saying it certainly does complicate the outlook for the Fed, and President Trump at least has indicated he's ready to sign this bill just within the next hour. So let's get back now to our guest, though, Mark Richards, head of dynamic multi-asset at BNP Paribas Asset Management, still with us. And Mark, just as we went to ad break there, we were talking about this diversification theme, and that's certainly the way that you're thinking about China as well.
Yeah, sure. I think when we look at kind of traditional benchmarks, within multi-assets, we're thinking about where are we taking active risk relative to a global ag or an MSCI ACWI. And I think China's an interesting kind of case study over the past 2-3 years. It wasn't that long ago that, what was the most bipartisan topic in the US was to be anti-China. We had a lot of the big pension funds pulling away from China. Whenever you hear the phrase, that's uninvestable, that's kind of a trigger point for us. And then we saw a tipping point in terms of Chinese domestic policy at the end of last year. So we've been allocating to China in various guises for about 12 months now. So that's both onshore, offshore, and also China tech. And back to our kind of earlier point about diversifying away from the kind of core of the AI thematic, think about China tech as being a good foil and counterweight to those positions.
Is it mostly pure a valuation play that you see why that China tech is possibly something that could be a diversifier? I mean, what else do you look at in terms of the AI sort of development in China versus other parts of the world?
Yeah, it's really that policy lever.
Yeah.
So we think about Chinese policy around kind of three fronts. There's kind of always that debate around are they going to really boost domestic consumption? Then there's clearly the international policy and the trade lever. Then there's kind of the strategically important sectors, and it's replaying on that third one, where we think both from a cyclical policy turning point and in a structural multi-year perspective, be allocated to that is a good position for us. That's quite an overweight position relative to those traditional benchmarks. It's also something that we don't feel that many people in Europe and the US are really allocated to, so it's a mispositioning rather than an outright valuation call.
On that valuation, though, another market that at least stands out for us in Asia, but maybe less so in Europe, is Korea, because it's, of course, a big AI beneficiary, and valuations still look cheap, even though you've seen a big run-up in names like SK Hynix or Samsung. What's the appetite as well where you are?
It's something that isn't mentioned a huge amount, maybe increasingly in the last few weeks, because we saw that comment from the Korean Stock Exchange around excessive price moves, I think, grabbed people's attention. But when we look at kind of bottom-up fundamentals, we see the best analysts on each stock, particularly in Korea, being quite far above the simple consensus. So we're thinking about where can we get positive surprises in the next couple of quarters of reporting, and there's still, those two companies specifically, and then the broader market as well. We also have the tailwind of corporate reform, which boosts re-ratings as well.
All right, hold on a second, Mark. We are getting here a little bit more updates on what's going on. That House vote, what we're seeing right now is that they have enough votes to pass the bill to reopen the government. So this was pretty much expected given what we saw in the procedural vote that happened just a few hours before that. So it seems like this is going to go ahead. Of course, the next step is this bill is going to be landing into President Trump's desk. He already said they plan on signing it in just about an hour or so. So certainly that's where we're headed here. One closer step to, of course, ending this shutdown.
Yeah, and Democrats certainly making some concessions as well in terms of their planned or their request around healthcare subsidies being extended. So, yes, we will continue to monitor this. As we said, the House now having enough votes to pass that bill to reopen the government, what has been a record 43-day shutdown rather in the US. But let's get back as well, because you mentioned earlier those geopolitical uncertainties, and I'm interested in your views on that defence tech theme. Of course, it's been a huge theme in European stocks this year. Is that going to stay intact, do you think, into next year? Or what's your view on sort of the cyclicality of it?
Yeah, it's a good question. I think there's in terms of broad geopolitics, I think has been a structural shift in the past 3-4 years that keeps that bid towards defence spending. There is a concern that, let's say there's a better outcome in the Ukraine conflict, that maybe the near-term appetite to really ramp up spending at a time when maybe other uses of government spending are more in demand, thinking about inequality, social unrest in most economies, the rise of populism as a broad thematic. There's going to be that kind of competition for government spending. So I think in the very 1 year time horizon, maybe we get a little bit of softening, because there's a structural change that's going to persist for many, many years.
Right, Mark, thanks very much for joining us this morning. That was Mark Richards there, Head of Dynamic Multi-Asset at BNP Paribas Asset Management. And just as we've been talking now, we do have the headline crossing that the House has passed the bill to end the longest ever government shutdown. This is 43 days in length, 650,000 government employees that have been furloughed. Whichever way you look at it, I mean, it's certainly a large government waste, essentially. But we are already hearing reports as well that many employees, government employees, are being told to be prepared to come back into the office on Thursday.
All right. So it looks like things are going to reopen there. As we talked about, it's not going to take days, sometimes even weeks, on some, really rebooting this government once again, right? Whether it's disruptive flights across the country, delayed food, as Belle mentioned, of course, the key data that investors are really anticipating here. Maybe September, some people say that could be where we see some of these key releases. October, that might be the tough one, according to the White House overnight, saying that they may never even get that sort of data released as well. So there might still be some uncertainty when it comes to the data side of things. We got plenty more ahead. This is Bloomberg.
Taking you back to live pictures here in Washington this morning, we do have the House that's just passed the bill, or a bill, to end the longest ever government shutdown. In terms of the market reaction to this, you have seen the S&P 500 futures just reversing some earlier losses. There's certainly economic implications, at least, from this, because this fight, which is dragged on essentially for 6 weeks between President Trump and congressional Democrats, has disrupted flights across the company. It's delayed food aids for millions and more. But essentially, what the projections are from the Congressional Budget Office is that this closure of this length is going to lower real GDP growth in the current quarter by 1.5 percentage points. Hong Kong pre-market session as well, just getting underway.
Yep, and there's lots to talk about here, whether it's tech earnings and the like to look ahead to. Tencent certainly is going to be a key focus here as well. But yes, it's going to be obviously a focus on games that could boost earnings for Tencent. JD.com, a rare sell rating when it comes to Morgan Stanley. We'll flesh that out for you as well. But they basically said winter is coming when it comes to this company here, when it comes to the e-commerce side of things. The Open is next.
Welcome back. You're watching The China Show this morning, and we're counting down to the open of markets. We are just a few moments away, and futures are indicating that we're going to see a few declines. Really, though, it was a subdued session on Wall Street overnight. Concerns, for instance, around a lack of economic data, for instance. What does that mean for guiding decisions for the Fed? But also in China, we've got earnings. In the thick of earnings, we've got Tencent, we've got JD coming up. Tencent Music actually overnight, one of the big drags on the Golden Dragon Index, even though you actually had better earnings. But some analysts were worried rather about the investment outlook.
Yeah, we'll continue to watch, right, how AI is being deployed, how is it going to be beneficial when it comes to, of course, the earnings side of things as well. But yes, when it comes to all the tech names, that's really going to be the key focus, is earnings in the next 24 hours. So yes, so we are on course for the U.S. government to actually reopen. Of course, we talked about that bill heading to President Trump's desk now as we speak, potentially, and he's expected to sign it in about an hour or so. That's what they've been saying there as well. well. So we'll give you the latest once, of course, that becomes official. But it's pretty clear that things are going to start opening. So take a look at that. I mean, that at least clears up one uncertainty in this whole kind of saga. But certainly when it comes to markets, that data vacuum that we've been dealing with might still happen for the next few days as well, right? So that certainly is one thing that we have to contend with. In terms of the open, we're pretty much flat and moderately, I could say, not going anywhere when you talk about one of the onshore markets here this morning. Keep in mind crude, though. Look at Shanghai crude. We're following what we saw with Brent and WTI there. We're dropping about 4% in, of course, some of these futures on the back of what we saw OPEC really flipping when it came to that market view from a deficit to a surplus now. And really a lot of lingering questions on what this means for oil markets as well. We're watching very closely CATL. There you go, slightly down there. Capricorn Tech is down about 2% here this morning. Keep in mind SMIC, some of these local chip makers are going to be reporting results as well after we had some disappointing ones, relatively speaking, when it comes to Huaheng Semi last week. Here's our Hong Kong dashboard right now. We're down about a third of 1% on the Hang Seng. We're sort of teetering around that 26,000, 27,000 level there. HS Tech is down some 1% at the get-go. So it's not doing too well in terms of Alibaba. We're down. Xiaomi, XPeng, which has been quite volatile, actually looking, relatively speaking, okay. But yes, it seems like Alibaba, we're down some 2% here right now. So certainly that's one key focus here. Let's take a look at how these individual tech names that we're waiting for results, right? So Tencent, JD, SMIC, and Bilibili all reporting later on today. Tencent's down 1%. JD.com is going to be quite interesting, right? This call from Morgan Stanley, a rare sell rating. And they basically say JD is the worst positioned Chinese e-commerce stock in the next 12 months as you start to see these consumer goods trade-in program fade. So, they say winter is coming when it comes to JD.com. Of course, when their earnings come out, the key thing is whether to look at those kind of food delivery losses there and how much is going to weigh on the company. So that's one thing to watch. JD.com down close to 3% right now. Oil stocks, of course, given the drop in crude, here's how they're doing right now in China. There you go. 2% losses for PetroChina, Bell.
Yep. All right. Let's take a look as well at one stock in focus. And you mentioned Tencent, of course. It's such a fascinating move that we're seeing in Tencent, the company, because, yes, you're under pressure today, but actually investors have been piling into shares because it's seen as a safer bet amid fears of an AI bubble and optimism over its online games business. The company, as we said, it's expected to report later today, but positive profit growth is very much the anticipation. So let's get more with our Asia stocks reporter, Jeannie Yu, joining us this morning. So, Jeannie, I mean, we just sort of shared that headline level, but just dig into the details. What are we expecting later today?
Yeah, as you just mentioned, when we talk to investors, they do see Tencent as a safer bet. When you read Goldman Sachs report, they actually have a calculation. They calculate the China tech profits combined. They're going to see a second consecutive profit decline for the whole sector. But Tencent is the only exception. It is the only company among the China mega caps in the tech sector that's going to report positive profit growth, which is really impressive. And especially after such a big, long bull run for all these AI names, investors, this season is going to be a season where investors are going to, gauge whether they're going to hold on to the rally or they'll keep chasing or they're actually kind of do some kind of profit taking on those names. I think Tencent in that sense is kind of like a defensive names for them, given all the, they're still able to deliver profit growth when its competitors like Alibaba, they're kind of they have to fight with Meituan, with JD.com in all the food delivery and quick e-commerce battle, which is really hurt their margin. But Tencent, on the other hand, they're having very stable revenue growth, on the back of games, which has a very, relatively higher entry barrier, is less likely to see price wars. So that is really guaranteed, and I think that's going to assure investors about the company's outlook.
Yeah, that's a good point. In terms of valuations, how are investors viewing Tencent's valuation now after the stock's been up 50%?
Yeah, more than 50% year to date in Hong Kong. But if you look at its major competitor like Sony in Japan, Nintendo in Japan, all those big names listed in Japan, US, they're all trading at much higher multiple than Tencent. And at 20 times is only like about like 5-year average. So it's a company. When we talk to a Morningstar analyst, he said it's a company that hasn't yet priced in any AI potential, trading at 20%. So if you baked in all the AI related stuff, as they're doing, they're trying to integrate all the AI technique with all their business lines from gaming to advertising. So if you kind of like trying to reflect that in those share price, it's far from, the rally is far from over.
Right. Jeannie, thank you, Jeannie. You there, our Asia stocks reporter, on what to expect out of Tencent. Looks like they could be doing okay, right? And probably better than the rest, given the fact.
I have to say, when she mentioned about the competition in the food delivery wars, I mean, you're probably glad you're not an Alibaba or a Meituan or a JD when it comes to this competition.
Especially if winter is coming, according to Morgan Stanley.
Yeah.
Right? Shivering words. Let's talk about JD.com, right? Also scheduled to report the third quarter results today. Analysts will be monitoring losses from its food delivery business. Let's bring in our China correspondent, Min Min Lo, on what analysts are expecting.
Yeah, as you said, a lot of focus is going to be just how much losses they're making in its foray into the food delivery business, right? That really kickstarted this price war between all the different food delivery platforms. The good news is its revenue growth expected to come in at 13%, which is pretty robust. It shows you that their new investments are generating new transactions, but they have been, increasing their expenditure tremendously, right? Overseas hiring, building out their overseas supply chain, logistics as well, with the launch of their new EU platform Joybuy. And you can see here the net profit expected to come in at 4.1 billion yuan in the third quarter, which is far below what it was a year ago, 12 billion yuan. That's 3 times less. And so that's why you have the likes of Morgan Stanley saying winter is coming for this company. They're saying that the new investments are expected to be a major drag for their cash flows, depleting their cash reserves for the next 3 to 5 years. And you add to that next year, we don't know yet if the government is going to continue extending that consumer upgrading subsidy. And this is a company that has very high concentration risk. Among all the e-commerce platforms, they are the most concentrated in selling consumer appliances. So that's why they are not the best position right now.
Let's shift and talk about e-commerce platforms outside of China, because we've got this reporting now that the Chinese tax authorities are sequestering or requesting data from companies like Amazon. What are the implications of that, and why are they doing it?
Yeah, so this is, from what we understand from sources, the Chinese government is not accusing any of these e-commerce platforms of any wrongdoing just yet, but they are requesting the e-commerce players ranging from Amazon to the domestic ones like Alibaba, Shein, Temu as well, to hand over data, third quarter revenue data of selected online retailers, because they suspect that some of these online merchants are underreporting their overseas sales. And if the data doesn't check out, then, if the retailers actually have to amend the data to match what the platforms are reporting, they might be subjected to back pay taxes up to 13% in VAT, value-added tax, because this applies to any company with an annual sales above 5 billion yuan. And think about 13%. That is enough to actually wipe out all their margins and put all these companies to, fight for their survival, especially after they already experienced the blow from the US with the removal of the de minimis rule. And now the EU as well is looking at implementing a similar rule, right? Removing the tariff exemptions for small parcels below 150 euros. It was slated to come in 2028, but France is now pushing for this to be implemented earlier next year. So again, a big blow for many of these small retailers.
Okay. Tell us a bit more about just how prevalent this sort of tax dodging is, though.
It's a bit of a gray area, but it can be quite common for Chinese retailers to open up many different branches across different cities in China to draw traffic, because a company like Amazon, for example, they might only allow one store to be opened up on the Amazon platform for one registered entity. So if you're selling hats, for example, you might open many different stores across different Chinese cities. And what they do is they take advantage of the tax differences between Hong Kong and China, because in Hong Kong it can be as low as 16%, in China is about 25%. So then you might just report your sales data from one Chinese company to the tax authorities, and you pay the Chinese taxes on that store, and then you structure the rest of the companies to be under a Hong Kong company ownership. So you route all those goods from these Chinese companies to the other Hong Kong companies, and you pay Hong Kong taxes for these profits that are booked to the Hong Kong company. So it's a complex undertaking, but if the government is able to track the discrepancy in the tax reporting, then it's going to be a major issue for many of these small retailers.
Yeah, and a major issue too, because one of the statistics I really loved in our reporting is that Chinese sellers now make up just over half of the global active seller base on Amazon. So it's obviously a sizable problem to be dealing with as well.
And actually it also shows you that maybe the Chinese government is worried about their tax revenue as well, because it's going down in the first half of the year. And that's overshadowing their desire to help these exporters through the tariff risk.
Yeah, Min Min. All right, that was great. That was our China correspondent, Min Min Lo there. And coming up, we'll talk with VANDA Insights. This is about their outlook for oil. Prices have posted their biggest drop since June, and that's on signs of a surplus in the global market. We'll have that ahead. And this is Bloomberg.
Oil prices in 2026 are likely to feel more pressure than LNG prices. There's a lot of oil supply that's coming back from the OPEC plus countries that had been holding supply back.
That was the Chevron CEO Mike Wirth there speaking with Bloomberg earlier, and his expectation that oil prices will remain more under pressure than LNG into 2026. But let's also take a look at what's happening with Brent crude over a two-day period here, because we have seen that quite significant drop in prices. And that's as OPEC as well flipped its estimate for global oil markets in the third quarter from a deficit to a surplus, and that's after the US production exceeded expectations. So let's get more on the outlook now. And joining us from Singapore is Vandana, founder of VANDA Insights. So Vandana, we've been hearing this all year, essentially, these concerns around a supply glut building. What do you make of these latest readings?
Good morning. And indeed, the jury is still out on that, I would say, which is why you're seeing this sort of seesaw in the market between concerns over Russian disruption in the wake of the latest round of US-EU sanctions last month, and the ongoing narrative, indeed, as you point out, that there's ample supply. So look, going into the fourth quarter of the year and then looking out into the first quarter of next year, these are seasonally low demand periods traditionally. So there is, and on top of that, you have had, of course, OPEC G8, the group of 8 members, increasing production by quite a bit over the third quarter of this year, and then continuing to do so at a slower pace through the fourth quarter. So all of that combined does point to a slightly oversupplied market. I think the question here, which is still undecided, is what is the extent of oversupply? So on the extreme, we are seeing estimates of 3 to 4 million barrels per day of oversupply, which would be quite significant just compared to the historical norm that I was talking about earlier. And some are saying that it's more a sort of seasonal lows that we see, which is about a seasonal surplus that we see, which is closer to about 1 million barrels per day. So that's sort of leaving the market in a very tough position. And of course, on the other hand, it's become quite hard to estimate the extent of Russia's supply disruption in the wake of the latest sanctions.
Yeah, I was going to ask you about that. What sort of disruptions are we seeing so far? We've heard some inklings from India, from China, possibly, of reducing their reliance when it comes to Russian crude. How disruptive has it been?
Yeah, so those are the most important signals for the market. Indian refiners have pared back, or cut back, one should say, Russian imports, crude imports, especially for December, quite substantially. Chinese refiners, a little bit less so. Chinese independent refiners, some of them, like the smaller ones, teapots, are not that afraid of secondary US sanctions and continue to buy. But all in all, this is a little bit of a different picture from what we have seen in previous rounds of Western sanctions, whether they were the EU packages or US sanctions, in that we see a much more cautious stance stance from the Chinese and Indian refiners. And even on the product side, Brazil, which is a major importer of Russian diesel, looks to have stepped back in recent weeks, instead pivoting to buying the product from the US and the Middle East and so on. So I think the US sanctions on Rosneft and Lukoil could be a little bit of a game changer. And then the US squashing Gunvor's bid to buy Lukoil's overseas assets, most of them are upstream, a little bit downstream, is also causing concerns over disruption, especially in the Iraqi field, where Lukoil pumps about close to 500,000 barrels per day. There's a bit of a question mark on the continuation of operations there. So I think the market is in that situation where, it's an ongoing recalibration, but very little to take from the past 3 years' experience of workarounds.
So how do you balance then those disruption risks against also this really fascinating report from the IEA talking about oil consumption, how it could keep growing until the end of the decade?
Yeah, so we're changing track completely now. So we were talking about short term to medium term to very, very long term, which has, my God, it's far more murky than anything I could think of in the short to medium term. And what you're referring to, of course, is the biggest takeaway for the oil market from the IEA's long-term outlook report that came out, World Energy Outlook that came out yesterday, is that the IEA has made quite a big pivot from its call for a 2030 oil demand peak and reinstating a current policy scenario, which the market players see as perhaps the most pragmatic, perhaps the most probable to unfold, in which it sees oil demand rising all the way to the middle of the century, close to liquids demand, close to 119 million barrels per day, as opposed to well below 100 million barrels per day that it had seen in sort of more aspirational scenarios. So I think the market will it's trying to wrap its head around these scenarios. It has become progressively difficult to try and predict anywhere beyond the next 6 months, let alone next 10, 20 years.
Yeah, we'll just correct myself there, Vandana. I said IEA saying oil consumption to keep growing until the end of the decade is 2050, as you say.
Yeah, certainly it's interesting, Vandana, when you talk about where prices are going to be, because when you take a look at the WTI prompt spreads, for example, it's briefly actually turned into contango, which is a signal of bearishness. What are we looking like for the next maybe 3 to 6 months? Is it range bound? What range are we talking about now?
Yeah, so the contango is related to what the market sees as, or decides finally, as the amount of oversupply. And we have seen the front end of that curve flip between slight backwardation and contango. The important thing is the contango hasn't stuck, which then again goes back to the point I mentioned at the outset, which is that the market is really undecided. It's become harder to decide between the opposing forces of a lot of Russian oil looking like it's getting stranded. Yes, it's translating into a lot of oil on water, but that's your paradox there for you. Is it locked out of the market because of the sanctions? So it's become hard to say. My base case remains a slight surplus, of course, through this quarter and going into next quarter. We may see continued flirting of the forward curve with contango, but I don't expect a deep contango. The shipping market, what you're paying for freight or ships is also not supporting the storing of oil on water.
All right, Vandana, thanks so much for joining us this morning. That was Vandana Hari, the founder of VANDA Insights, and we'll have more ahead, including what's happening with Samsung or Samsonite shares this morning, because we are seeing them absolutely surging just in early trade, but it has been a strong earnings period for that company. And also we've got an upgrade for the business as well from Jefferies. So more ahead. This is Bloomberg. Well, in some world news this morning, Democrats are again pressing President Trump on his ties to convicted sex trafficker Jeffrey Epstein, highlighting emails that suggest the president knew of Epstein's activities. A congressional committee released 20,000 pages of documents, including emails that appear to allege that Trump spent hours in a house with one of Epstein's victims. Trump posted on Truth Social that Democrats are trying to bring up what he calls a hoax to deflect from the government shutdown. Meanwhile, House Speaker Mike Johnson says a vote will happen next week on legislation to compel the Justice Department to release files on Epstein. Taiwan's government says it's considering using semiconductor export curbs as a diplomatic tool. The foreign minister says Taipei hopes not to weaponize chips, but may act if nations harm its interests. It's a sign that Taiwan has not completely abandoned a tool that it briefly threatened to deploy this year against South Africa. China's US soybean purchases appear to have stalled despite the recent trade truce. Traders say no new shipments have been booked, and analysts expect demand to stay soft. That's after China stocked up on cheaper South American beans. US cargoes also remain more expensive and still face a 13% tariff, leaving crushers little incentive to book near-term volumes.
All right, checking markets here right now. Samsonite and the like earnings coming through here. When it comes to Samsonite, there you go. That pop. Massive one of 19%. So there is the likes of Jefferies upgrading the luggage maker to buy from a hold. So they're talking about positive outlook for the fourth quarter, solid travel demand. Certainly we've been seeing it here in Hong Kong as well. Tencent Music, that was the one that was a bit of a miss there as well. Let's skip Rhee. We're talking about SJM. That was the one actually that had a miss as well. That stock also falling substantially if we can actually fix that here right now. In terms of Wingley Development, this is one stock we're talking very closely here as well. So they are working when it comes to CATL, when it comes to ESS, that buzzword again, energy storage. There you go. You see Wingley Development up close to 5%. We mentioned last night that kind of the transfer was really people buying metals, buying treasuries and selling oil. Take a look at how gold prices are and where these miners are doing here right now. There you go. All up this morning. This is Bloomberg. Welcome back to the China Show. A look at the HSI half hour into the session. It is Thursday, and we are continuing to see just modest declines here right now. There's not a whole lot of conviction in these markets here. Yes, the news that we got in the last hour was that we are setting the stage for the U.S. government to, of course, reopen after the longest shutdown in history. In this hour, we're expected to see President Trump sign that bill, which officially confirms the rebooting of the government. But yes, as we talk about, still a lot of uncertainty when it comes to how quickly people can get back to work, how quickly air traffic can be resumed, and of course when we can get key data.
Yeah, absolutely. Will we ever get some key data is another question. But you'd mentioned that sort of lack of uncertainty or conviction. I mean, you've seen that very much expressed in trading volumes today, because pretty much across the board, and definitely in Hong Kong, you're pretty far off what you'd see on a 20-day moving average basis. But looking across the markets, there's another key thing that we're tracking, and that's very much the earnings one. So you've got all of these companies on tap later today. Tencent actually is a really interesting play, because it's sort of being seen as one of the sort of better AI beneficiaries. Yes, Alibaba gets all the headlines in China, but Tencent is also building out its AI tools. It's got a lot of consumer data as well to develop those. SMIC, a key name to track, of course, has been one of the big beneficiaries in that move to self-reliancy in China in the semiconductor space. Earnings as well overnight, and we're actually getting some reaction. I mean, Samsonite, for instance, really surging. Yeah,
looking pretty good. Jefferies giving an upgrade to a buy now on the back of this kind of solid travel demand that you're seeing that they're being rewarded from investors. They were up 18% for Samsonite. When it comes to SJM, that's another story here, because what they said in the earnings in the third quarter, revenue did miss estimates. Citi maintained that sell rating, of course, on the casino operator, and they're saying there's continued market erosion here with the absence of meaningful progress updates for SJM. Tencent Music also heading lower by 12% here this morning. We're watching oil plays as well. Given the drop in oil that we saw, we are kind of holding on, I guess, to some of those losses there. We're seeing that extend when it comes to Shanghai futures here this morning. Crude, which is down some 4% on the back of what we heard from the OPEC Plus as well, right? Changing their market view and really seeing now a supply glut versus a deficit. That IEA report is going to be quite telling later on today as well. And we're watching how the Asia side of things looks, right? We talked about how things are not that, I guess, risky, or are people not willing to take these risky bets? Asia Pacific, we're pretty much flat right now. U.S. futures, though, are slightly perking up, though, on the back, of course, this news. But Taiwan, even the Kospi, they reopened, an hour late because of the exams. We're not seeing that much appetite there today, too.
No, but to your point around U.S. assets, we have sort of seen a reversal of some earlier losses in S&P 500 futures, and that's as we await, of course, President Trump set to sign that stopgap funding measure later this hour to reopen the federal government. Let's go to Washington for an update from our Congress reporter, Alicia Diaz. And Alicia, thanks very much for joining us this evening, your time. But let's get started here because we're expecting President Trump to sign this bill. What happens next exactly?
So this is, finally the end of this long, hard-fought battle between the Democrats and Republicans to get their policy priorities in place and to finally end this historic government shutdown. But it will take some time for some of these consequences that have occurred because of the shutdown to be put back in place. It sounds like possibly weeks before air travel is back to what it used to be, but airlines are optimistic that that will be returned to normal by the Thanksgiving holiday. So it will take some time to completely get back to normal, but this is all, of course, moving in the right direction and finally putting some type of end to all of this chaos.
Can you tell us, I guess for markets, the key thing is data, right? We heard from the White House saying, we might not even get October data ever. What are some of the kind of constraints that we might be dealing with the next few weeks?
And with that possibility of never getting the October and some of the data that was set to come out during the shutdown. And it remains to be seen, what's going to happen over the next coming weeks and months. It sounds like there will be some sort of an adjustment period before we get back to normal, so to speak. So without a doubt, there's going to be some continued uncertainty for the markets before they get back to the slew of data incoming that they're used to.
Something that's been a big, I guess, distraction as well over the past few hours at least, but clearly prior to that is the release of more Epstein emails that seem to place President Trump in Epstein's house with one of his victims. That's, of course, the allegation at this stage. But how is that also going to complicate matters over the coming days or weeks?
So we also have this discharge petition that is set to be signed by the House. We had the final signee signed into Congress today, Representative Grijalva, and she really pushed that through the door. And Speaker Mike Johnson said he's set to bring it to the floor over the next couple of days. But as you said, at the same time, there's been a slew of emails already being released by some of these congressional committees. This information is sort of trickling out regardless as part of the thorough legal process. And so this will be mostly a sort of a political test for Republicans on if they're willing to succumb to the, push for transparency, as they say, or if it may put them in a tricky position regarding the allegations with the president as well.
All right, Alicia, thank you. Alicia Diaz there, a Bloomberg reporter joining us out of D.C. this evening as we wait, of course, that bill to be signed by President Trump this hour. Looking at FX markets, it really has been sort of that bid for the dollar that we're still tracking here today. That carry trade seems to be going on for another day. But take a look at what we saw overnight, right? When we did see dollar yen briefly touch 155, that brings us back to levels we haven't seen since February. And you did see some, I guess you could say, verbal sort of intervention to kind of talk down dollar yen, but it hasn't really really quite worked, right, of late. Korean won as well. We've been seeing quite a bit of weakness there. We're just around that 1470 level here this morning. Let's bring in our chief Asia FX and rates correspondent, Ruth Carson. She joins us from Singapore. Ruth, yeah, dollar yen at 155 level, I think a year ago would have sparked a lot of intervention talk. What's expected this time around?
Yeah, it's incredible to think where dollar yen is, considering the Bank of Japan has been raising interest rates and the Fed has been cutting too. But it really sends a strong signal. The macro markets community is sending a very strong signal on Japan. The Bank of Japan may not be raising interest rates quickly enough. Now, considering inflation has obviously been well above the central bank's target, currencies are always a release valve when there are pressures in the market. So that's exactly what we're seeing right now. Yvonne, you pointed out dollar yen at 155 overnight. It's come down a little bit, but still, these are levels that are incredibly elevated considering where rate differentials are. And let's not forget, August last year, it was at 161.95 when we saw that huge meltdown from the yen carry trade. 155 is not entirely too far away from that level.
Let's also talk about another currency that's weak in Asia, and that's the South Korean won. Of course, you're looking at the lowest levels since around 2009 or approaching those. But what does that mean then for the BOK and their capacity to protect the currency as well?
Absolutely. And we know that there's a ton of pressure as well from trade tensions through to the $350 billion investment pledge that Seoul has given to Washington as part of trade negotiations. Now, all of this is weighing on the won. The won is very much a risk-sensitive currency. As soon as the Asian trading day opens, the won is closely watched as a barometer for sentiment. And if you look at where dollar won is trading at the moment, 1470 or so, certainly showing pressure, showing negative sentiment towards South Korea. And again, currencies are a release valve, so we'll most likely be able to continue to see potentially speculative attacks on the won and also just pressure, selling pressure on the pair.
Yeah, I mean, Japan's in that same position, right? That $550 billion pledge that they have for U.S. investments, which is, I think, half of their reserves. So, Ruth, it begs the question, if we do see sort of some intervention in Japan, for example, how effective is it going to be, given the fact that Takaichi has talked about her plans for fiscal expansion?
Absolutely. And this is the tussle that I think is playing out in global markets. On the one hand, you're right, we're seeing lots of intervention, jawboning, right? We're watching the yen with urgency. Currency traders, we're watching you. Be careful of what you're doing with Japan's currency. But if you look at where the currency is traded versus dollar, 154, 155 on any given day, it's, how effective is it is up for debate. Because you're right, when you look at the bigger picture here, Takaichi has said that she wants Japan to grow and there are fiscal expansion plans. So when you take the longer term view, inflation's just going to be higher and the Bank of Japan is likely not raising interest rates as quickly as markets want. And if that's the case, rate differentials will still be in play majorly, which means more pressure still on the yen.
Ruth, thanks for that, those insights there. That was our Bloomberg Chief Asia FX and Rates correspondent, Ruth Carson in Singapore. And shifting now to what is a very big day for China earnings, because you've got Tencent leading the pack. AI investments and gaming ventures going to be under scrutiny. JD.com also set to report with food delivery losses in the spotlight. And analysis we've got coming up with Bloomberg Intelligence. So more details on that ahead. You're watching The China Show. Taking a look across assets this morning, you're seeing some mixed moves rather in Asia stocks so far. The broad tilt is fairly steady, actually. We had a very subdued session on Wall Street overnight. Investors are cautious because not only is there a lack of data, you're also anticipating key earnings in China as well. Tencent, JD.com, just some of the names on tap for today. But let's also shift now to the Eco Outlook and bring in Yifan Hu. She's Regional Chief Investment Officer and Head of APAC Macroeconomics at UBS Global Wealth Management. So, Yifan, great to see you in studio this morning. Let's talk about 2026. I mean, I feel like the year has just sort of flown by and we're already forecasting. So what are you talking with clients about right now?
Yeah, I think that's the most interesting question now. I think that for 2025, if we see the China's GDP growth, like we think we'll end up with like 4.9% to 5%. So for the next year, we think the government could set up the target between like 4.5% to 5%. So in our view, if without like a major stimulus, so the GDP could reach around 4.5%. So we will have probably lower for the first half, the high for the second half.
How significant would that be? Lowering at least that range when it comes to that growth target for next year?
I think this year is around 5%.
Yeah. Mm-hmm.
So I think that if it's end up with 4.9%, so it's also hit the target. So it's possible for them to give a range rather than say around 5% again. So because like the next year could be lower unless the government wants to put the major stimulus. But we think the chance is not very high. So I think they would rather put like a range, maybe more comfortable for everyone.
So not major stimulus. That's more of the fiscal side. What about the monetary policy side?
Monetary policy side, I think we'll still keep easing and keep accommodative, and we still expect like 50 to 100 bips of the cut by the end of the 2026, and also maybe 20 to 30 bips of the interest rate cuts, because given our CPI inflation is still pretty low.
What are you expecting to be kind of the bigger drags next year? Is it the export side of things is going to be a bit softer than this year? That has been quite resilient. And are we just not expecting any sort of meaningful recovery in the consumer?
For the consumer side, I think we think it still will be like between 3 to 5%. We didn't see too much highlights about that. I think but the major driver should be still for the industry output side. Industrial product, because AI-driven applications, and also with this kind of advanced manufacturing, and possibly we call the new productivity growth. So I think that will probably lead in the driver. On the other side, for the energy side, I think that especially this year we see for the energy reserves, like a new energy, and also for this kind of the high voltage electricity transmission, that's all could become new highlights. But for the consumption side, I think it will be, in my view, I could call it stable, but will not be very strong. Property will still be the drag, but we don't think the government will put too much efforts on that. So we'll just let it go unless it's have the cliff the drop, but that's the chance also small.
Picking up on that theme around increasing automation you were just referencing there, how does that also impact the jobs outlook and the employment outlook as well?
In this sense, I think for the AI application, so one side, of course, more jobs may be taken by the machine, but at the same time, we think maybe service sectors still have the chances, and also with a new AI applied services sectors, maybe there's some more we call the experience exposure a services sector come out, that's more digitized, and also with this kind of more entertaining, or even with more creative, more service-oriented job opportunities. But still, I think there is still a pressure.
And you guys upgraded Chinese tech just a few weeks ago, and saying it's probably the most preferred, right? Most attractive here right now. How are you looking at this rally around AI and the like now, and how do you position around it for next year?
I think for this year, AI already rallied for 2 years, last year, this year, especially for this year, almost over 30%. But I think about it, for all these kind of big platforms, very similar to the US, Magnificent Seven, I think they just started. Because one side, I think their valuation is still relatively low, 30% of discount comparing with the US peers. And the second, I think for the China, the AI investment is still like a capex is still increasing, like similar to the U.S. And also third, I think it's a little bit different from like the U.S. side. I think that China is more like an ecosystem. So I think that with this kind of ecosystem, with the basic research, like then the AI application with this ecosystem could like the spillover effect. We think it could be bigger.
One of the sort of issues, I guess, around the AI application side is sometimes low barriers to entry. What are the sectors that you look at in terms of that AI theme in particular as being a bit more resilient, I guess?
I think the AI theme will range you from the low end to the high end. So if we can like AI applied like advanced manufacturing and new materials and also healthcare, I think it's booming because of the AI like the application. And we also could see AI applied to maybe like aerospace and also some like many like new fields. I think just like speed up the exploration and also like innovation.
What are some of the key themes you're watching out? I mean, for the fourth quarter, because I think there's been a lot of allocation into domestic tech already, especially you take a look at how institutional investors are kind of positioning. Do you think that this is extreme levels when you talk about fund concentration now? And you know, we've already started to see some rotation out of tech. Can that continue in the fourth quarter?
Yes, I think that it started with the tech, and also like the concentration with tech. We think the tech still have the loom, but we also see it's applied to other sectors as well, like gradually. For example, we think that this year it's also very shiny sector is for the energy reserves, because by now for the new energy already supply 35% of the China's like a total energy supply. So I think that's like a very like significant number, and we also see like maybe the healthcare will benefit because their price has been low and could benefit like maybe with this kind of application. And for the consumption side, that side is we have the new consumption, but too high, and it's not easy. But I think that we still have this kind of the new materials, and we also see for the sector like booming out, and also the AI is not only the software and also have the hardwares, but of course most companies are in the A listed, so that's the reason we also think the A shares and could also could slightly better perform than each year next year because with all this kind of the like hardwares.
So that's the equity side. What about the fixed income side? What are your preferences there?
For the fixed income side, because we still expect like for the interest rate will go down. So I think for the bond side, I think it's not very attractive, but the existing bond, of course, like I think I still like have the gain.
But the PBOC is buying bonds again, right?
Yeah, that's true.
Is that likely to be more measured this time around?
I think PBOC, and also I think the PBOC also. I think that this year we also see for the companies actually issue like Chinese for the CNY bonds like in Hong Kong. Yeah. So I think the government like PBOC buy bonds. I think it's more like keep the monetary. They call it. They don't call it quantitative easing, but I think it's more like provide the liquidity adjustment of the liquidity provision in the market.
Yifan, thank you. Yifan Hu there, a regional chief investment officer and head of APAC macroeconomics at UBS Global Wealth Management. We got plenty more ahead. This is Bloomberg.
We're coming back with some breaking news here. Japan's exchange is looking at ways to curb crypto hoarding firms. Now, just to set the context here, crypto hoarding firm or a digital asset treasury company is a public company that strategically acquires and holds digital assets like cryptocurrencies on its balance sheet as a primary business function. So sort of built in the mold, you can say, of Michael Saylor's Strategy Inc. That's fallen sharply over the past few months. So what Japan Exchange Group now is looking at measures to limit the growth of these so-called digital digital asset treasury companies. That's according to sources, but concerns are certainly deepening over losses connected to this frenzy. It is an important backdrop to note as well, because you have seen stock exchanges in Hong Kong, across the Asia Pacific, resisting efforts to set up new digital asset treasury companies, or so-called DATs. But in contrast, Japan's actually listed 14 listed Bitcoin buyers, and that is the most in Asia, according to some data that we also have in this exclusive reporting that's just coming out. So you're seeing Japan exchange there just a bit under pressure. But let's also get to some other global news that we're tracking this morning, because Taiwan's government says it's considering using semiconductor export curbs as a diplomatic tool. The foreign minister says Taipei hopes not to weaponize chips, but may act if nations harm its interests. It's a sign that Taiwan has not completely abandoned a tool that it briefly threatened to deploy this year against South Africa. China's US soybean purchases appear to have stalled. That's despite a recent trade truce. Traders say no new shipments have been booked, and analysts expect demand to stay soft after China stocked up on cheaper South American beans. US cargoes also remain more expensive and still face a 13% tariff, and that leaves crushers little incentive to book near-term volumes.
All right, we're taking a look at what it comes to, yes, Thirsty Thursday, maybe a way to call it. Yeah, talk about the beer makers here. Asahi Group coming out with their October beer sales in Japan actually was down less than 10%. So maybe, I don't know, the market is taking it not as bad as what they expected, given the fact that the cyber attack recently that did cripple their systems. They did talk about shipments currently at just 10% of normal levels. But maybe, you see the likes of competitors like Kirin coming up with numbers where beer sales were up 19%. They are in some ways seizing that opportunity here right now. In terms of the energy space, we're watching, of course, how they're faring all lower here this morning in Asia, of course, after that dip when it comes to crude here, that long-awaited surplus. Is it finally arrived? This is Bloomberg. Well, 11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a moment, and we're watching very closely, of course. Right now, when it comes to stocks, we're not seeing that much appetite, although the topics is a little bit better. We're up about 0.6%. It's all about the FX markets, though, that we saw overnight, right? That dollar bid continues for another day. We briefly touched that 155 level for dollar yen. We've come off that just slightly here. But we were just talking to Ruth Carson, right? The risk of intervention this time around is a little bit different, given the fact last year, it was more about intervention here at a time when, the BOJ was ready to hike rates. This time around, it's a little bit less certain, given the fact that we have a new government and a prime minister that really called rate hikes stupid.
Yeah, exactly. I mean, that's...
She's toned down of late, but yes.
It has toned down, that's right, and certainly wary of spooking markets, I guess. But one of the sort of litmus tests is going to be that 5-year auction coming up later today as well, because we've got Japan preparing to sell 5-year debt a day after you had some members advising the Prime Minister that Japan, or suggesting that Japan should spend more than it did last year on its upcoming economic package. So that's also something in focus. But sticking with Japan, because we've just had a scoop coming out in the past few minutes, we've learned around the Japan Exchange Group.
Yeah, we'll get a little bit more on that story coming up here and how they're trying to limit this whole sort of crypto hoarding sort of frenzy, right? We were checking in terms of earnings, right? What comes next? Tencent, JD.com, those are the next ones in line here in terms of the China tech space as well, right? Tencent, we were just discussing really how it is, relatively speaking, the more defensive play, I guess, in the China tech space, given the fact that, their core business is still games. It's a little bit more insulated from what? Price wars, tariffs.
Yeah, it's so fascinating, actually, because Alibaba always grabs the headlines for sort of being the AI star in China. But actually, Tencent is a company. It's building out its AI efforts. It's got a trove of consumer data that it can pull upon as well. But this is what we're seeing from analysts and their expectations around net income growth.
Yeah, for more, of course, we got our team to talk us through Tencent, talk us through JD. We have Bloomberg Intelligence senior analysts Robert Lee and Catherine Lim to tell us about what they expect here as well. Robert, I'll start with you on Tencent. What's expected this time?
Well, I think the graphic you've just put up says everything. Consensus estimates up around 5% with substantial downgrades across the e-commerce space. So, again, as you've said, what would Tencent's tagline be? Defensive growth. It's a leader in many of its end markets. It's a high-margin business. It's well diversified. And ultimately, if I was going to use a dog analogy, they're like the Black Labrador, they're the German Shepherd. They are loyal, they're reliable, they're defensive, and they deliver. So, they should report solid numbers tonight. In terms of their Q3 numbers, the risk of a negative surprise, famous last words, is fairly minimal. But yeah, they're not exposed to some of the ongoing weakness we're seeing in other sectors of the market, particularly food delivery, which they have a minimal or almost non-existent exposure to. E-commerce, again, they're more of a payments platform on that side, so they benefit from the transactions going through. And as you've said, they are the world's leading video games company. They're a ubiquitous part of life in China with their WeChat super app. And their AI strategy, finally, is sensible. It's pragmatic. They're applying AI to realize synergies and cost savings within their business internally, as opposed to Alibaba, which is more focused on external customers, which exposes Alibaba to the external market forces, cost pressure, pricing pressure, and margin pressure. So, compare and contrast, Tencent is, a mutual fund manager's favorite for obvious reasons.
Yeah, that's interesting, I guess, how they're using AI. But what about the gaming outlook in general? Because that's very cyclical in nature, and we were sort of expecting maybe a slowdown in gaming a few months ago. It doesn't seem to have transpired as much.
I would say, that's their cash cow business, because the margins are very high, again, reflecting their market leadership, and they've got a broad portfolio of titles which are, consistently strong. So, yes, there's been some slowdown in that side of the business, but the real standout in gaming this year has been their overseas games. So particularly the likes of Brawl Stars, which is a smash hit, particularly with my daughter Yume. Sorry, just a name check there. She'll like that. Apologies. Sorry.
Name drop.
Yeah, name drop Yume. Twice. I did it twice there. But anyway, back to the script. Brawl Stars is a real smash hit, and Tencent is a major shareholder in Supercell. So it's their overseas business that's been doing extremely well, and underpins the strength in that business.
Catherine, I don't know if you saw that graphic just now, right? What analysts are expecting, a 77.6% drop in net income growth year on year for the quarter when it comes to JD.com. You have the likes of Morgan Stanley saying winter is coming. Is winter coming for JD?
Well, you know what? Winter is here. If you think about how Meituan, during the last quarter results, they've already gone out and told everyone that they are ready to sink into losses for the first time for their core local commerce business, which is essentially delivery. And, just to highlight food delivery, it's no longer about food. It's about everything that can be delivered to your house, like whether it's 30 minutes or under, 10 minutes for some. That's what the e-commerce companies are doing right now to try and actually get consumers to actually consume more in new scenarios in China. So that's going to eat into their margins. We've actually seen those numbers comes down very heftily, not just for JD.com, for Meituan, for Alibaba's e-commerce as well. And really, I think the million-dollar question is that, have we seen the worst of it?
Have we seen the worst of it? I mean, what's going to be sort of the gauge on that? And it's not just the domestic competition; it's also that spending on the build out of the platform abroad.
Yeah, Annabelle, I was waiting for that question. I think, depending, and I really don't think that, at this stage, any of these companies will be able to actually tell you and guide for 2026, because there's a lot of moving factors, including the reality that, general consumption in China is still fairly lackluster. And what they are essentially doing is also trying to actually stimulate consumption, within the economy itself. So they're still, again, coming up with new businesses, etc., to try and stir things, within the country. Going overseas itself, spot on. For JD.com, we're looking at them acquiring C Economy in Europe, and we're really going to see how they're going to leverage on that to actually try to grow their overseas business, which similarly to Meituan's Kita, they will likely be incurring more costs rather than revenue. So that's going to actually weigh on their profits.
Yeah, I guess some near-term drags there. Well, that was our Bloomberg Intelligence senior analyst, Catherine Lim, there in Singapore, and Robert Lee as well here in the studio covering the outlook for Tencent. And subscribers can actually turn to the terminal for more on Tencent's upcoming earnings, because we have a T-Live kicking off at 4:30 p.m. local time in Hong Kong today. T-Live Go is your function for the latest updates, plus commentary and analysis from our expert editors.
Yep, and we're taking a look at what comes to Japan markets, right? We're on break right now, but we saw this big move just a few minutes ago. Shares of the Bitcoin treasury company Metaplanet are down some 7.5%. Now, that's after this report. Bloomberg has learned that the Japan Exchange Group is considering measures to limit the growth of listed digital asset treasury companies as concerns deepen over losses connected to the crypto hoarding frenzy. For more on this, let's bring in the author that broke this story here, Alice French, our Japan stocks reporter. Very interesting scoop here. Tell us a bit more about what's being considered right now, what they're trying to achieve.
Yeah, hi. So basically what we understand is that there are some jitters within Japan Exchange about these so-called digital asset treasuries, right, or DATs as they're being called. So these are companies that kind of following in the footsteps of Strategy, run by Michael Saylor in the States, who have basically started hoarding cryptocurrencies on their balance sheet. In Japan, the biggest example of that is Metaplanet, which used to be a hotel operator and now has over 30,000 Bitcoin. So we understand that JPX is looking into potentially kind of a more strict application of their rules around backdoor listings, also potentially, requiring such companies that want to shift their main business operations from things like hotels to things like buying Bitcoin. They might have to go through another audit, which of course is lengthy and potentially expensive, and that also there might be some new restrictions coming in on how much they can fundraise and how they can use those proceeds. So we're really feeling some kind of nervousness around this sort of quite new industry, and this is after a lot of the companies in this emerging sector have seen their share prices dip a lot since the summer. There was kind of a rush to buy crypto after, Trump came in the US and his kind of pro-crypto policies, all of those tailwinds. And then sort of from midsummer onwards, we have seen somewhat of that bubble bursting. I think Metaplanet, for example, down over 70% since June after really, really booming earlier in the year. And yeah, we're hearing that there are some concerns amongst regulators around how to sort of regulate this new industry going forwards.
Yeah, I'm curious why you think Japan's taken a more relaxed attitude to these so-called DATs. I mean, they really stand out in the Asia region. And also, if you could just maybe clarify a little bit for us, what's the difference between a DAT and a simple crypto ETF?
Yeah, it's interesting, right? And just a few weeks ago, we had actually written kind of more broadly that the other exchanges across the Asia Pacific, as you say, including Hong Kong, have been taking a slightly stricter approach. Our understanding is basically that, the exchange's approach here is that as long as you disclose what you're doing, listed companies pretty much have a free rein, as long as shareholders approve, of course. But this regulation, this kind of potential crackdown has been accelerated by the shareholder losses. Now, you bring up ETFs there. I think Japan is a particularly interesting case because there are not crypto ETFs here yet. And that means that, if you're just an individual shareholder and you want to get exposure to Bitcoin or other crypto, one way to do so is through the stocks of these listed companies. Also, direct holdings of crypto here are taxed very highly. The capital gains tax can be up to 55%, whereas if you, for example, hold it in your tax-free NISA account, stocks of these companies, it's a great way to get in on that crypto boom. And so I do think Japan is a sort of interesting outlier, but seems like it's kind of now coming into step with what's happening across the rest of the region.
Alice, great story there. Thank you so much. Our Japan stocks reporter Alice French joining us out of Tokyo. We got plenty more ahead. This is Bloomberg. All right, checking the one here this morning. We were talking a bit more about, it is set for one of the weakest levels since 2009. You start to see foreigners dump the stocks in that market. And right now we are hovering around those levels here this morning. We did talk to the Bank of Korea governor. He has signaled that while the central bank remains in an easing cycle, the timing and size of any future rate moves depends on upcoming data. He spoke exclusively with our inside anchor Haslina Amin in Singapore.
So from a Bank of Korea's perspective, we don't believe that monetary policy alone can control the housing prices. But on the other hand, we are mindful that ample liquidity wouldn't throw the fire to the real estate market. We need to coordinate. There are a lot of government policy has to be coordinated, not in the short term, but in longer term perspectives. And I think government is considering new supply policies together with many other policies. So we'll see how it's going to affect. I don't think that it's going to have a very short-term impact on the price itself. But at least I hope to see the slowdown of the rapid increase of housing prices in metropolitan area.
So rate cuts are still on the table. Some say why? Because when you take a look at GDP, it's come in higher than expected, and trade looks pretty resilient. But
at this moment, given the negative output gap still, our official position is that we will maintain the easing monetary cycle, but the magnitude and timing of the cut or even the change of direction will depend on the new data that we'll see.
Yields have been surging to levels perhaps that suggest that rate cuts are no longer needed, and perhaps even a rate hike may be in the making. Is the bond market, are the bond traders misguided in thinking that?
At this moment, our bond market yield react not only to the domestic factors, but also global factors, such as the possibility of the U.S. Fed decision and also the dollar strength.
If the Fed does cut, does that provide you enough, room to cut your own rates?
In general, definitely the lower interest rate in the United States will give us some more room, leeway for us to have a more independent monetary policy through the exchange rate channel or through the bond market channels too.
Despite that resilience we're seeing in the dollar, there's been a lot of talk about debasement, how people around the world, countries around the world are pulling away from U.S. assets. Do you see debasement happening?
No, actually. I think we have discussed this quite a lot. But actually, if you look at the actual capital flows in the last 6 months, I don't see that there's a lot of talk, but there's no real movement away from dollar.
Well, that was the Bank of Korea governor there, speaking exclusively with our Bloomberg Insight anchor, Haslinda Amin. And I think it's really interesting what he was saying about the steps that the BOK is willing to take to essentially defend the currency. I mean, it's been under so much pressure, approaching its weakest level since around 2009. And you were just referencing earlier, it's also down to foreigners looking to essentially offload some of their holdings.
Yeah, you've seen that really when it came to some of those big mega cap names like SK Hynix, like Samsung of late. And it does lead to a lot of questions about the sustainability, of course, of this whole AI trade. When you're starting to see volatility shoot up in Korea, is that a sort of canary in the mine sort of signal there? It's interesting, this call from this Seoul analyst that has a brave soul when it comes to Samsung and SK Hynix. We're talking about Morningstar, and this is Jing Jae-yu. So he mentioned here, expectations are so high, the drivers and all the catalysts need to be right to go even higher is very easy to disappoint. So, they're saying basically these stocks are very vulnerable to sharp declines on just minor setbacks, right? Any sort of inkling of news could lead to, of course, people pushing the sell button.
Yeah, and you're looking here at that amount of foreign pressure or foreign selling pressure we've seen on SK Hynix in particular. It has been really that darling, because even though you see Samsung playing catch up in HBM now, SK Hynix has really been at the forefront. I think what's interesting to note, though, is, yes, you've had those impressive run-ups in both of those companies this year. They're still looking cheap, though, when you compare them to their counterparts in the US, because you've got Samsung trading at 11 times forward earnings. You've got SK Hynix just 8 times forward earnings. But you compare that to a price-to-earnings ratio, you're looking at 27 times for a gauge of major US chip makers. So, yeah, you've had the run-up, but still cheap.
Yeah, I think maybe it's just profit taking from foreign investors right now. We just had that chart about them dumping those stocks, right? In fact, you're talking about when it comes to foreign ownership of SK Hynix, that's actually now down to the lowest level since May, according to data there. So there are some signs that maybe cracks are forming when it comes to this trade. It's not a one direction sort of thing anymore, because people are really starting to think how much these sort of aggressive spending is really going to bear some fruit.
Yeah, it was interesting actually when you just talk about that profit taking. I mean, that was exactly the strategy we were talking about with BNP Paribas Asset Management in the last hour, because Mark Richards was talking to us about how they entered the Korea market, they sold down their holdings and they re-entered. So again, it is that profit taking very much in play, and we're talking about it here on the show. But anyway, let's shift on to some corporate news we have this morning as well, because Zhongji Innolight is said to have picked banks including CICC and Goldman Sachs for a Hong Kong share sale that could raise over $3 billion. The optical device maker already trades in Shenzhen, where its stock has surged 300% this year. The company says it plans to list in Hong Kong, though the size and timing are still being finalised. Bloomberg's been told that Chinese discount online retailer VIP Shop is considering a Hong Kong listing as soon as next year. Sources say it's working with advisors on a potential share sale, though the talks are ongoing and again may not lead to a deal. VIP Shop's US listed shares are up 47% this year, giving the company a market cap of about $10 billion. Hon Hai's offered a rosy outlook for the year ahead, pointing to artificial intelligence development as its most important growth driver. That's after it reported a better-than-expected 17% surge in September quarter net income. The assembler of Apple iPhones and other hardware also expressed cautious optimism about a recovery next year in consumer electronics. And indeed, you are just seeing Hon Hai trading a little bit to the downside this morning, but we'll have plenty more ahead. This is Bloomberg.
Okay, good morning. Last week, San Francisco, Silicon Valley. Then on the weekend, made it back to New York City for the marathon to watch one of my daughters run. So proud of her. And now, it's Tuesday morning, I'm in Hong Kong on the Kowloon mainland side. And this town is not quite up this morning, but I think it's beginning to rise from the challenges it's faced since COVID. Business activity picking up, IPO activity picking up. And I, of course, have a very busy day ahead, speaking at a conference, seeing a bunch of friends, clients, and colleagues. See ya!
Aw, John Gray, thanks for the shout out from Hong Kong. I don't know if you track him on LinkedIn, right? He has these fun sort of videos of him running around all around the world, different cities, and really kind of talking about each market, what he's excited about. It's really created quite a following, right? And you wonder why we're showing it. It's actually the big take today. The story of them really kind of transforming Blackstone in a way from being something that's very exclusive to maybe institutional investors to something that's much more bigger for everyone. And trying to be relatable is something that is a new approach from Gray.
Yeah, exactly. That is exactly the sort of theme and the challenge that he's made for himself as well, because exactly to your point, they're trying to focus on those institutional investors, but they're also trying to broaden the appeal of Blackstone to the retail crowd as well, because you don't just want those institutions, you want it to be a financial superstore, essentially. That's what we're calling it in this story, but for the dentist, the lawyer, the teacher next door as well. It is, though, it's a test, essentially, because you can also risk backlash from pensions and endowments by following this strategy.
Well, it came on the back of what we saw from President Trump, right? This sort of executive order that was a bit controversial, allowing private equity to actually reach millions of 401ks, right? So, that's why they're kind of following this policy. But, for Gray, though, the vision, he says, runs deeper when he talks about, he really wants to create Blackstone almost like a Walmart, almost like an Amazon, where if it works for one market, why can't I do it for all
Yes.
right now.
Yeah, he kind of likens it, I guess, to McDonald's in a way. Just because McDonald's is doing well in the US, there's no concern or there's nothing you should be worried about if you see McDonald's trying to take that strategy and to reach more markets.
I love what they say, though, right? It's like he has to be able to be relatable, but not cheapen the brand of Blackstone.
Yeah.
That maybe deters a lot of these institutional investors to, work with them, right? So it's a balance, but I think he's making it fun in some ways, right? I love that it was inspired because it came from him sending messages and videos to his daughters first, and then his team said, look, do it more for everyone.
Yeah, you could be onto something here. But anyway, that is the big take today.
I'm inspired. My next run. Thanks, John.
Please get on LinkedIn for us. All right, taking a look at the Hang Seng intraday as we go into break here, but that is it for the China show this morning. Insight with Haslinda Amin is next.